Well, Treasury yields rising today after softer-than-expected inflation data and a $39 billion auction of 10-year bonds. For more on the Treasury move and inflation risks, let's bring in Subhadra Rajappa, Societe Generale's head of U.S. rate strategy. Subhadra, great to have you with us.
Thank you.
The markets cheer the softer-than-expected data, but you say you're not buying into that.
Yeah, because if you look beneath the hood, you get a very different picture. I mean, you look at a broad variety of metrics. I mean, airfares went down, but you saw things like used car prices start to go up. You've seen other categories within the CPI basket, recreation, apparel, all of that went up. So you kind of have this haves and have-not story, if you will. Although the headline was, lower than expected, point to headline and core, overall, I thought that some of these underlying, parts of the basket showed that inflation was still quite sticky.
So, Subhadra, thanks for being here. We haven't seen tariffs yet. How do you factor that into your expectation for rates and inflation?
Not as of yet. I mean, we're still looking for details. We just don't have much by way of information from the administration on what exactly is going to get passed. But if you look at, the bond market, I would argue that the bond market is actually looking at, somewhat of a softer CPI print, but looking past that and saying, you know what, we haven't really seen the impact of tariffs yet. So once we start seeing the impact of tariffs, that would mean higher inflation prints and a Fed that's going to be on pause for a lot longer. That's part of the reason why you saw the market start to, price out cuts that were priced in ahead of the CPI print.
President Trump's first administration, they talked about the stock market being a report card. This one, they seem more focused on the bond market, and they want interest rates to go lower. Treasury Secretary Besson has talked about it. President Trump. Can they do anything to get bond yields lower?
Well, they can jawbone. For his part, I think Besson as well has told us very, very clearly that Besson and Trump don't want 10-year yields going above 4.5%. They want to see borrowing costs contained. They want to see a pickup in the mortgage market. The mortgage market's been pretty much in stasis for a while now, so they really want to see that pickup in these consumer-led areas. And really, the way to do that is by keeping 10-year yields low. If 10-year yields get to around 4%, you're going to see a pickup in the mortgage market. That's great for the economy.
Given what the administration has said about the 10-year yield, though, where do you expect it to go? Last time you were on Fast, back in January, you said 5%. We totally see 5%. Where are you now?
I think Besson has really capped the rise in 10-year yields. I mean, 4.5% is probably as high as it gets. And if anything, I think that the risks to yields are skewed to the downside. So I can see 10-year yields actually head towards 4% if we start seeing any sort of weakness in the data. The Fed's going to keep policy on hold for the foreseeable future, at least for the first half of the year. Beyond that, I think you're going to see the long-end yields actually gradually decline and the yield curve flatten. And, that's because the market's going to start looking towards tariffs and potentially the impact of tariffs on growth.
It's a tough, though, sort of dual mandate to navigate here. If prices are going to go higher because of tariffs, and we haven't seen the full effect yet, et cetera, but the job market will certainly soften, at least from the last print that we got, even if you just say government jobs are going to be reflected, or the cuts in government jobs will be reflected in the numbers going forward. How do you view that dual mandate and what wins out? And is that why you think the Fed will just be on pause as opposed to actually doing something in response to these two mandates?
So after today's CPI print, I would argue that the Fed would be much more focused on what happens on the employment front, because inflation has been trending lower. You've had this, disinflationary trend for, the last year or even longer. And now, if there's any sort of weakness in the job market, I think that the Fed is going to be, prepared to cut rates. I mean, if you look at what Powell was saying last Friday, he was saying that, they are okay to be on pause because they can cut rates quickly if they need to.